All right. Hello and welcome everybody to MoreTalk, where it is 2 p.m. on the East Coast and
It is 11 a.m. in sunny San Diego.
excited for today's call, or I should say today's podcast. For those listening out on Spotify, please give us a subscribe. If you're listening on the YouTube podcast, we're actually 10 hours away from getting to 100 hours, which is a significant milestone for anybody listening in the mortgage industry. Start building your YouTube station, because Tony Thompson told us at the state and local that, yes, 93% of all millennials, which is driving the purchase market, according to many articles that I don't have in front of me, yes, 93% of all millennials mortgage search starts actually on YouTube. A lot of pens and jaws dropped on that fact from the research they did. And the first step is actually 100 hours of viewed content. So if you're listening to this podcast, thank you for that hour. And we look forward to having Bobby Nicely on the show, who is a leader of an IMB. And as you've been following us over the last, I think we're on month 10 now. We talk a lot about the dynamics of IMBs versus brokers, versus wholesale and other channels, and big ones versus small ones versus those in between. And let's dive right into it. Bobby, do you want to give us a little bit of background, and we'll get into you in a second, but just Alcova Mortgage?
Sure. Excited to be here. Thanks for having me. Yeah, so Alcova Mortgage is based out of Roanoke, Virginia. We've been in business since 2003, so 21st year in business. We are an independent mortgage banker. We've been that way since about 2008. We were a broker to start with and transitioned into mortgage banking right in the middle of a financial crisis. So we've had a few of these challenging markets that we're dealing in now. Been through a couple of those, and looking forward to getting out of one of these and back into a normal market.
I think one of my favorite things about you personally, Bobby, and then your company, as I was reflecting on what to talk about this week, or Mike and I to talk about, one of my biggest complaints about myself is, and I think it's the nature of being an entrepreneur or the mobile app, easy mortgage apps coming out of the gates, but I got caught up a lot in metrics that were important to investors or metrics that were important to success. And I know this industry gets caught up in volume and units, whether they're talking about the success of their team, their loan officers, or just talking about what's needed for profitability. I think you've been able to keep a constant culture really grounded with how you look at everything. You even were telling me about a family experience that really taught you, life's kind of more important than just showing up and working your way through it. Can you talk about how your feelings on that and how you've brought that from a leadership perspective to Alcova to make it different than some of the ones that just revolve around President's Club?
Yeah, well, our purpose statement is create a better way to serve. We try to live and breathe that and make sure that we're truly operating from a servant's heart. It's easier said than done. It's good to talk about, but it takes a commitment. And obviously we have some days that are better than other days and in meeting that mission. But, we don't want to be all things to all people. We just want to be the best we can be at what we do. And sometimes you can chase volume, you can chase success and not like what you catch if you're not careful. So we want to maintain, the culture we have and integrity that we feel like we have on our team. We have a lot of great people. We want to grow the company, but we don't want to be, at a certain size where we would lose that family feel. We have about 500 employees right now. So, overall with our culture, I appreciate you saying that. We do work very hard at that, and it's making sure that we lead with our purpose, not just with certain goals that we might have for ourselves.
That's incredible that you can maintain that type of family culture, especially in the environment that we're in today. I know that there's another East Coast IMB that also tries to maintain that family culture, but how has the recent environment in this last year and a half, let's say 2 years, with the increase in rates and the reduction of inventory and volume, what kind of workplace environment challenges have there in, and what have you done to squelch any fears of maintaining that environment? Going from, hey, it's kind of like mom and dad are at kids, and the kids feel that tension, and that's where we've been at right now in the environment with the higher rates, lower inventory. What have you done to reduce the amount of fear in the family there?
Yeah. So good question. There isn't an easy answer. I mean, anybody that says that they've handled this perfectly the last couple of years would be, I think, not being truthful. So I'm sure we've made mistakes along the way. We've tried really hard to just be transparent about what's going on and why we're doing certain things. I think one of the things that gets lost in our industry, especially as companies have to downsize and lay people off, is, that the reason that IMBs have to make sure they're keeping up with the market. We have certain demands with Fannie, Freddie, our warehouse banks. And so if you're not profitable or you're not showing a path to profitability, it affects the entire business. So it's not just about, not that I think it's about this with any IMB, but it's not just about, how much the owners are making or, how overall profitable the company is, or keeping owners bonuses or executive bonuses. It's really making sure the company's healthy to be in business forever. We want to look at things with an infinite mindset, not just we got to get to the next year or the next 2 years, the next 5 years. We want to be in business for 50 years. So, how do we approach things that mindset? And so making sure we're healthy as a company. And that means, sometimes that you have to, in a corrective market like this, you have to make some tough decisions. You have to cut pay, or you have to, lay people off, and it's not fun. But I think just being transparent about the reasons and really trying hard to keep people, trying to sacrifice first. So that's not the first option. We've definitely had to make changes like everybody else has, but we tried our best to explain, the reasons behind it and show that we're willing to take sacrifices as well in order to do that. So I think there's no perfect, easy way to do that, but I do think that from what I've seen on LinkedIn and some folks that have been displaced, sometimes they can come across very cold, and we never want that to be the case here. We want to maintain the family environment, but also have the real conversations, just much like a family would or should have when times are going tough. It's not all sunshine and roses and sunshine and rainbows. It's, you got to be honest. So, and that's the thing, is not to mislead people with the challenges and the why behind it. Why would we have to lay off, 3 underwriters? Why do we have to lay off, 2 processors? It's not just because the company needs to make more money. It's sustainability. It's the reasons we're doing it. We want to be here and have these opportunities, 10 years from now.
The last few IMBs that we've had on the air have talked about what they have done to stay in their lane, whether it was sticking with we had one IMB that's sticking with the USDA market, which is like one of the hardest. At least I'm in San Diego, so USDA is not very commonly funded. So for them to want to say, hey, we're the USDA leader in the entire state, or whether you're sticking to government loans or what have you done to stay in your lane? Because obviously, as an IMB, everybody is scrambling. I'm going to do more non-QM. I'm going to stick to that. What have you done to stay in your lane to be successful as an independent mortgage banker?
Yeah, so for us, we're all in on 100% retail origination, branch business, local in the community. We've dipped our toe maybe 10 years ago or so at Consumer Direct. We feel like it's a very challenging space to be in. We've looked into wholesale before, but we believe to be successful, it's all about our branch network, and it's all about supporting our loan officers and local communities and going all in for our loan officers and all in for our communities. So that's been our strategy, to stay in our lane, so to speak, like you're talking about.
And how many states are you in right now?
We're in 20 states right now. We're licensed in 20 states. Most of our branch network goes on the East Coast, from Maryland down to Florida. We do have a branch in Texas and, a few outliers, but majority of our branch network goes from Maryland down to Florida.
We do like to get a little raw on this station, so we ask a couple curveballs here. Bobby, why do you think the appearance of this industry is never one that is hire people out of college, build them up, kind of make them great, and they stay, right? It seems right now the image, and that might not be, you're welcome to talk about Alcova versus the market, but when you read the news, it's this company got recruited there, this company got recruited here. It just seems like it's very hard to build it up the way it maybe needs to be in the future.
Yeah, the competitiveness of our industry, you're normally looking for loan officers that have a network or have already built a network because obviously when you hire them, it can be immediate return on investment. I'm not saying that's the right way to look at it, but that's certainly the way that we as lenders look at loan officers is, okay, they're doing X million now. At least they have a network. Hopefully with our tools and our resources and our commitment, they can do more than that. They can increase their business versus hiring someone that's unproven and not known. I've started out at college as a loan officer, so I have a little empathy for this myself. But I have noticed that there's a very high failure rate with loan officers, and not just out of college, but just people that come from other industries. I think we've got to take ownership on some of that as an industry, in training. I think we've all tend to invest more in our systems, our processes, our procedures, and less in training. We've really tried hard to do better at that the last few years. We hired a really good VP of training about 3 years ago. She's been a great hire for us and really helped us change that. But we still have a ways to go because it is difficult to train someone from start to finish, because there's a technical aspect to it and there's a sales aspect to it. And it's very rare for someone to have a high aptitude for both. And so generally speaking, you find someone that's better at one or the other. And if they're better at sales and they're not great at the details and that sort of thing, then they have to have a lot of support, like at LOA or whatever. And it takes time for that to be profitable, because if you're out running around getting deals, but you don't know how to structure them, or you're not that good yet, it's just the payback. It takes a real strong ROI commitment. And then, like you said, the challenge, and this is a big challenge for industry, you train someone for 2 or 3 years and they're producing and they're giving you a return on your investment. And then all the vultures come out, they want to recruit them. And, that's where we got to do our part and make sure we built a strong culture. But even then, if someone throws a signing bonus or extra basis points or whatever, you run the risk of losing them. So I think that's the reason why we don't see more of that, as the risk reward. We haven't found the right math for that yet.
Yeah, I'll give a quick story. So in building easy mortgage apps, I always tell people we maybe sold about $10 million worth of the software, and very little of it ever came back to me, which is frustrating. People say, how's that possible? There were times we probably spent 50 to 6 figures on workarounds because lenders did not want to show a list of their loan officers, even if we could do it really the way it is today, right? Really cool drop-down pictures. We were going A to B to L to P back to C for years. And then in hindsight, you could make it really easy now because lenders, I guess my question is, how do you think the iMergence, Ingeniouses, Model Match, I'm going to try to be nice to all of them here, MMI and others, how is that changing the game? Like maybe on the example you just spoke about, Bobby, or in other ways, sending them to local events now, MMBA events, because there's less you can do to keep people from finding them anyway. Has that changed from a leadership standpoint? Do you have to be more on guard? Do you have to build more moats and be cognizant of that? Or are we still early in the stages of that software being prevalent?
No, I think it's, especially in a market like this, it shines a light on those that are producing. So I was talking to one of our top producers last week, and we had a sales trip, and he was joking. He drove on his way down there. He had 3 or 4 calls, and he, of course, he told me, he's not going anywhere and he's happy here. But he was just laughing at how many calls he gets. And, he tells people, hey, I'm not interested, but they just constant harassment. So you know what's happening. So I don't think there's a way to avoid it or try to hide your loan officers or do anything like that. I think it's just, it gets back to culture and relationships. And if you're not taking care of them, then you risk losing them. So we look at our loan officers as one of our customers. We have 3 customers: a loan officer, the borrower, obviously, and our referral partner. We've got to take care of all 3 of them. And that. You just got to know, hey, they're getting calls and, probably going to get some offers here and there. And some of those offers might be even outside the market, depending on how desperate somebody is. But, we try to make it more than money. And again, back to that longevity, what's your best situation you could be in over a 3, 5, 7 year period. Don't just look at 1 year or 2 year, because even with some of the signing bonuses that lenders have paid, there's a lot of handcuffs with those signing bonuses.
Yeah. So how do you shield them? I'm going to say that your company culture, and I don't want to get too foo-foo with this, but I would say that in reading your profile and what you post, that your company culture is actually shielded with love. And the reason I say that is because a lot of people don't like to say that word, especially when it comes to their staff. Can I ask you on that level, how do you love on your salespeople so that they feel loved enough to say, you know what, I want to be with the family and I want to be here. And I know I got people calling. It's funny. And it's kind of like, we're all getting called to some extent, either A, commiserate, or B, build each other up. So how do you foster that inside of your culture? Because it sounds like that you're good at it, based upon what I'm reading. How do you think you foster that?
Well, some of it is that, again, back to our purpose statement, create a better way. It's, don't rest on your laurels just because somebody's happy and you've had a good run or you've got a good relationship. I guess it's a little bit like your spouse. I've been married 21 years now, actually, about the same length of time we've had the company. So
Congratulations.
if I were to neglect my wife, I can't just say, well, she's been with me 21 years, she's not going to leave me. If I were to neglect her and our relationship was to be strained, then, that's going to be a problem. And I think we've got a real problem. And look, we're none of us are above this, but there's a real problem with ego in our industry. And, if you're not careful, you can say, well, we've been over backwards for these loan officers and we've got such a great platform. And then the loan officers are saying, but I bring all the business. And, sometimes we get into these situations where ego takes over. And I've seen it, before, and I've heard it from other companies and people we recruit, and they leave because something small turned into something big because ego's gotten involved. So we try really hard. And again, I don't want to make it sound like we don't struggle with this too sometimes, but, just drop the ego. How do we fix the situation? We're going to make mistakes, own it. Don't try to blame everybody and investigate the problem for 2 days. Like, okay, we made a mistake. We own it, fix it. Quickly too, it doesn't need to go to a committee and have 17 people weigh in before we render a decision. Own it, fix it, move on, drop the ego, don't take offense to it, and there are a lot of really good people that, say a lot of good things, but you also have your days when people get frustrated and they say things. And, if you're not on the top of your game, you can take it personal. And then all of a sudden, a good relationship starts to go south pretty quickly. So I think, just trying to constantly create a better way and as best we can, drop the ego and just, realize that we're in this together and listen, is the other thing too. Just sometimes just shut up and listen. We think we have all the answers as humans, and God created the old saying, God created 2 ears and 1 mouth. And so sometimes we just got to be quiet and listen.
No, absolutely. And for those listening on YouTube Podcastle, or Spotify, again, please give us a subscribe. This is where it's important to us. Tune in on Mondays for our mic drop, a benefit of having to subscribe so you can see it. We also meet every Thursday at 2 p.m. Eastern. You can use hashtag MoreTalk. That's MoreTalk, because we're trying to be a radio show where we have people call in. So Mike Cush called in last podcast, last week. And so we want to put him on the Velix Valuations hotline here and get him up here to ask a question or make a comment. And anybody who wants to do so, please join us on Thursdays. We are promoting this. Please come up. No strings attached.
Come on up. Ask away.
Am I on the Velix hotline, really?
They're a sponsor of Adopt the Brand Velix Valuations. I try to keep that sports radio feel on here sometimes.
All right. So I just wanted to say something, then I wanted to ask Bobby a theoretical question. When you're talking about the hiring and we don't hire people out of college in the industry, et cetera, certainly that is the case. I do think the call centers do that, right? They bring in kids from college, train them much easier because they're sitting in the office and there's control of, whatever. And I think the best people in a call center end up going outside and leaving and becoming outside loan officers. So, I think that in certain parts of the country, especially, the outside mortgage lenders benefit from the training grounds of the call centers. But, whatever, that's certainly understandable. It's much easier to do in a call center. My question for Bobby was, our industry tends to hand the value proposition and the lead aggregation over to loan officers, right? And our business sinks or falls on the ability to capture loan officers because they're going to go out and get the business.
Yeah.
I think that when you look at banks, I think we would probably all agree that if Wells, Citi, Chase, and Bank of America wanted to get back into mortgage full force, they would take a huge chunk of market share very quickly, right? Because they've shown throughout history they can do that pretty much whenever they want.
Do you mean, Mike, just real quick, do you mean retail, or do you count correspondent where they're not the
Well,
client?
I think both, but even retail, right? Even retail, they can capture because they got an office on every corner in America, right? And I think that shows that some people are willing to walk into an office to ask for help, right? Now, I understand that a lot of their business is correspondent, but they also did collectively a pretty big chunk of retail. My question is, knowing that they can have people walk into a store looking for help with a mortgage, my question for Bobby is, did you ever think about or attempt or try to say, you know what, we're not going to make our value proposition, we're not going to hand it over to LOs, we're going to attempt to get out of that business, like to take it over control of it and get people to come to our store? And I know that's a very idealistic concept, but the solution is you're always dependent upon LOs and their comp demands and all the stuff that you just talked through.
Yeah. So look, I mean, I don't think you're doing yourself any justice if you don't consider a lot of different models and how they can impact your company. But we're all in on the loan officer and the local loan officer. And the reason being is, the relationship aspect of it with a local real estate agent and the local community, those two things. Yes, there is, they cost more. And I think that's why there's a temptation to say, can we do this without loan officers? And, loan officers can be pushy. And look, I was a loan officer before we started Alcova, so I was pushy too. But that's also how deals get done and why realtors like to send those deals to loan officers. So, we got to be careful saying, we don't want pushy loan officers and then we're not getting the deals because the loan officers aren't there to push them across the finish line and help the borrower, hold the borrower's hand and get them done. I do think there was a big shift since the Great Recession. I think that the banks pulled back because of Dodd-Frank, and they haven't really ever pushed back forward. And I don't think they like the risk-reward ratio. So independent mortgage bankers, it's been well documented, took a lot of market share since 2010, a tremendous amount of market share compared to before that. And I don't see that changing too much because even if a customer walks into Wells or Chase or whatever, you've got to have a really sophisticated person to put that deal together in most cases. Now, it's getting easier on some, perfect cookie cutter conventional loans. Technology has come a long ways, but even on paper, it looks perfect. There can be something about the transaction that could cause it to go awry. And if you don't have someone monitoring that or working with the borrower closely and the realtor, the whole thing could blow up. Even on somebody that's well qualified and has plenty of income and all that, there could be a way something was documented, doesn't meet Fannie's guidelines. And so for all those reasons, at this point, we're better or worse, we're all in on the local loan officer at the local level.
As part of the support they need, I'm hearing like a conversation I heard the other day is, since Sue is in the audience, someone was talking about right now they're looking at about a 4-to-1 ratio. So they pull 4 credit reports for every closing. And with the recent increase in prices there, plus the work number, it's almost like $300 a closed loan on credit reports, because if you count the 4, right, for the one that you get, what are some of the changes that eventually leadership might have to sit down with loan officers and say, is there a way to change business models? Should borrowers be paying for certain things? Can we work with, you must be having some of those conversations. Can we work together to figure this out so we can have market advantages in certain zip codes?
Yeah, no, it's a great point of emphasis right now because of the credit costs and all the work number, all that stuff. That gets into capture rate and trying to work with your loan officers on getting those numbers as high as possible. Because when you spend money and then they go somewhere else over $100 processing fee or something, then we got to kind of look at ourselves in the mirror, and say, why do we not show enough value to not keep that client? So I think that's one of the things, is just making sure that we're going back to basics on selling our value, much like the real estate agents now. A lot of them are going to have to do with the NAR ruling, not to get off topic on that, but it's all about, are we explaining our value? Because if it just comes into a rate game, with the trigger leads and all the stuff we've got going on now, it's really hard because there's 1,000 lenders or so out there, and somebody's got the lowest rate, but that's, it's one of 1,000. So if somebody wants to spend 8 hours a day searching for the lowest rate, they can most likely you're going to be able to find the lower rate. And I don't care who you are, broker, lender, banker, somebody out there is probably has a lower rate. So the difference is it might not be the best value. So the best value might be our slightly higher rate because we're going to get it closed in 12 days for you. And we're going to give you some financial advice that's very impactful for you. So I know that's kind of a long-winded answer for what you're looking for. So I think the first thing is making sure we're getting as high as capture rate as we can and do a better job of explaining our value so we don't lose more than we have to. And then, this, it's one of those chicken or the egg things. If all lenders would charge an upfront application fee or commitment fee, and if you choose to leave or go somewhere else, you don't get that back, that might be a solution. The problem is if you're the first one to do that and your competitors say, we don't do that, then it's difficult because it's so competitive right now. I mean, it's just the most competitive I've seen it in 21 years in terms of everybody's going after the smaller pool of borrowers we have right now. So that's the risk. So
I agree with what you're saying. Like when I originated, even the call centers that would call, and it just felt nauseating saying, well, they're not quoting you a real rate, right? Like at that point, that's not the point. The point is at that point, they've created confusion with the borrower. And if you haven't shown your value, you're saying better capture rates will bring down that number from credit reports pulled to close. And that's really the only way that it's going to get solved, at least over the next couple of years, unless legislation or something changes. I think you brought up what some brokers are going to argue about UWM and why rates don't always matter. Do you think, though, that enough flashlights are going to come out of this? And I say flashlights, I take it from Faye Schwartz, who's a huge beacon of great changes in our industry. And she always says one thing our industry does so well, and I think she was speaking on stage about appraisal biasness at the time, is when you put a flashlight on it, our industry rises up and comes out better for really many things over the last decade or two, and has proven again and again and again that they do things the right way. You just got to put a flashlight on things sometimes. And it seems that broker channel has a flashlight on what is the right way to do it when you say you're a broker. But I guess rate doesn't always matter, right? Do you think they're just going to have to document why they chose, or do you think it'll just be status quo from a regulation standpoint?
Yeah, I mean, my feelings on that is, I think attorneys and lawyers do a really good job of finding these type of situations and avoiding them sometimes. And I'm not necessarily taking up for UWM. I don't know Matt Ishbia, but I'll say that, you can't, when you say that they overcharge borrowers and you use some sort of statistics because you find a lower cost option, to me, that's a terrible way of looking at it. We've got to do a better job, like you're saying, when the flashlights come out, of explaining our industry better. I mean, I think there's a lot of confusion over basic stuff. The CFPB I've seen has been questioning discount points, for example. Well, the reason discount points are up
via blog too, Bobby. They're not giving you any guidelines. They're just blogging it like, hey, they're wrong. Who's going to get enforced first? It's just so unfair.
Yeah. So, we've got to make sure we're explaining that we're not just a commodity, that, you don't, it's not a push button, here's what you get. And everybody has the same process. And, why did you go with Alcova? Because you could have saved $73 if you went with XYZ lender based, 700 miles away without a local presence. Well, I could give you 10 reasons why that you would want to go with a local lender that knows the local market, that has local underwriting and so on and so forth compared to a competitor. But until you've had a situation as an agent, and agents can really speak to this, until you've had a situation where the loan is falling out the day before closing because of a guideline that's been missed the whole time, or the deal gets pushed back a week because underwriting fell behind and there was no one to push the service level to what it needed to be to get the deal done, and you just blow by a closing date and the stress that caused. I mean, 33%, I think Calc has this figure, which is one of our partners, but 33% of the people involved in a real estate transaction cry. It's so stressful. So when you've got a situation that's stressful, then you're not always looking for the lowest cost provider. I mean, you certainly don't want to overpay, and you don't want someone that's going to be out of the market. You got to be competitive, but you want someone that can really get the deal done. And then on top of that, if you can coach them and make sure that you're giving them options and putting them in the best loan for them and their situation. I mean, everybody's situation is different. It may make sense you may have 30% to put down, but it may make sense for you to put only 5% down or 10% down, because that other money that you have, that other 20%, might be better to pay off another debt that has higher interest rate on it. And call center's not going to tell you that. lowrate.com, whatever they may be. He's not going to tell you that most likely. So that little bit of advice may have saved you hundreds of dollars a month. So yeah, I'm pretty passionate about the lowest rate is not the best value. An online lender, otherwise, we should just wave the white flag and let the online lenders take over all the business, because they're always going to have the lowest cost, because they pay they pay the lowest comp for the loan officers. They have the lowest overhead, and they're running on very thin margins. So you get what you pay for. Same in lending as it is, going to a restaurant or anything else.
Or wedding planning, right?
Yeah.
The lowest cost wedding planning is very risky to do.
Exactly. Yes.
Do you think that then everybody who is a salesperson gets to own their own business? So as you're talking about, you want to be around for more than 50 years. And I would hope that you'd also want some continuity, not only from a sales leader, but you'd want that sales leader to develop a team, so that team would be around for 15 years, whether that leader was there or not. And if that's fostered, then, in effect, what you're doing is you're telling your borrower, hey, you know what? We want you to be around so that your financial security is going to be around 50 years. Maybe you're not going to hold that mortgage for 50 years, but we're going to be your team to foster that type of relationship, whether it was the preparation for the purchase of the home, or the preparation for the purchase and then the refinance as rates begin to drop. And so how have you began to foster that then with your support staff, so that the entire company has this, hey, we're going to be around for 50 years and we're going to teach you how to do that? How do you train your people to do that in that type of business within a business within a business? The business of Alcova, then the business of your sales team, the business of the operations, and then the business of the household that you are helping with their biggest investment in their lifetime.
Yeah. I mean, I think it making sure they know how important it is for them that we want to be their lender for life, and telling as far as our people go, that's to the borrower, to the consumer, that we want to be here for you, and communicate that consistently, not just during the loan process, but in our follow-up emails and calls. And, we try to do as much of that, as many touches as we can a year, to remind them of that and give them good, valuable information, not just email them for the sake of emailing them, but give them valuable information as a homeowner, so that they will, continue to return to us, and make sure that they know that we're there for them, whether it's a servicing question, whether we're servicing the loan or not. And then as far as our team, it's just, we preach the vision is to be the most customer-centric mortgage company in the country. That's our vision. That's where we want to be. We're not saying we're there, but that's where we want to be. So in order to achieve that, to be the most, not the best, or one, not good or great, but the best and the most customer-centric, that's a real commitment, to making sure that we're putting our clients first. And sometimes that may mean losing money on a deal to satisfy the customer. Now, obviously, you don't want to do that on every loan. You can't do that all the time, but or if you did do it all the time, you wouldn't be in business long. But you got to put the customer first and have that mindset. And we really try to preach that. And it's an ongoing, daily discipline. Again, I don't want to make it sound like we got all these things figured out. It's just, practice what you preach.
Do you think it's practiced? I know that you have it, but do you think it's practiced in the majority of your branches?
Yeah, I mean, I definitely do. I think we get together as many of our sales folks twice a year as we can, and I think that's important, because it's really easy to get distant with your teams if you're not seeing each other that often. So we do get together twice a year, and then we have a lot of Zooms and other ways to stay in touch and to talk. And then we have a role within our company. It's really a relationship manager role that spends a lot of time working with the branches and working through problems and kind of being their advocate. And if there's something they need or they're not getting, or there's certain issues that pop up that they work through, and through that, our goal is to make sure we're modeling that. So when decisions come up, like, okay, it's technically not our fault, but this is off $100 or $200, and we could debate and push back. We did everything right. We're in compliance, but is it worth it to fight over that $200 when we could eat it and move on and have a happy customer? Because it's probably going to cost us more than $200 in the long run. So we don't want people to stop and investigate and have a 2-day investigation over $200 and cause a problem with the customer. Just move on, take care of it and move on. So sometimes those sacrifices show up, and it's how we handle it. Because again, it's easy to say that, but then if it costs you $1,000 here or $500 there, if if you start pushing back on that and don't make those decisions, then your words don't mean much. So we try to, when I say practice what we preach, that's really what I mean. Is just when those moments come up, show the loan officer, show the branch, like, look, we're going to own this. Technically speaking, we didn't do anything wrong here, but we don't want to get into that. We're finger pointing. Let's just do the right thing and move on. And again, if it continues to happen, it's a training issue. Then it's not that we just accept that we're going to have hundreds of those happen a month. I mean, that would be a terrible business operation. But when you have them, own them and don't let it derail your relationship with the branch and with the customer. And through that, I think the branches see our commitment to that, and we see if they do the same. Do they take ownership? And then so it's when we have turnover, it's almost a self-select type thing, because they see that this is what's expected of me. This is the kind of service level that Alcova expects, and either I'm not committed to it, or these guys are fanatical about customer service, and I'm not quite that extreme or something.
With the rates going up and people talking about some numbers coming out this week, the next rate cut actually was my prediction, September. I mean, that's where it's supposed to be, but I just did some funny math on saying 15 months. I'm not an expert, but might get lucky here and be right. So are loan officers able to, or are they interested, if this trend continues, in learning about how to sell HELOCs and HEIs and other vehicles, financing like that, for two reasons? One, maybe to make money, depending on which one. But two, to at least be having that conversation, coming off as a financial advisor, giving that touch point in between the long length now it's going to take between first mortgages. When will that kind of dam break where they'll be asking for the training and you'll finally be able to bring them the training and start moving that product, whether it's making money or breaking even and being relationships?
Yeah, no, it's a good question. I mean, we do have a second mortgage product that we rolled out a little over a year ago, and we are working on some HELOC options. The challenge there is making sure we can do them with excellence and making sure that it's the least somewhat profitable, because the challenge is, particularly on HELOCs, and I think we've got a good resource for that. It's in a trial period right now that we're getting set up, but we think we found a good resource for that. But in the past, especially if you originated it, underwrote it, and close it, it was hard to compete with a credit union, because they typically would do them for little to no closing cost and have really great rates and all that kind of stuff. And for a independent mortgage banker, it's hard to compete. So it makes a lot of sense, but when you run the numbers, it's gotta, what you don't want to do is have a whole bunch of money, have a mediocre product, and not make any money on it. Or have a whole bunch of money invested in it and be mediocre at it and have mediocre rates and then not make any money. So we think we found a solution to be good at it and to make money at it. And if that's the case, we will definitely move forward and do more of that, because it does make sense. I mean, we want to be able to give our loan officers as many options as possible. But again, we don't want to put the customer, just because we can make money, we don't want to put the customer in an adverse situation when we know they can go down the street to the credit union and get a lot better deal. That kind of gets into a ethical dilemma. We feel very good on the first mortgage that we can be as good as anyone with our value proposition. And so again, another long-winded answer for you there, but the answer is yes, if you can be good at it and be very competitive with the rates and so forth.
When will the loan officers finally, do you think, come a little bit more organized and say, okay, we need to be telling our clients about these products, which means we need to be educated, because we're going to be calling out of the blue to people we've already closed, and what's out, like, what are people doing? What's out there? I guess, are they going to be able to do that, making less money than they make on first mortgages, or is it just not worth their time and you're going to have to find different people in the company?
No, I think the loan officers can do it. The process has to make sense. And if you were going to make, let's not talk basis points, let's just talk flat dollars. So let's say you're going to make $200 on HELOC, but you're going to have the same amount of time invested as a regular first mortgage. You would have to be starving probably pretty bad to do that, because it takes a lot of work to originate, one loan, one purchase transaction, for example. You've got a lot of time tied up into it. So if you've got that much time, if you've got half the time or a third of the time, then all of a sudden that $200, makes sense. So I think it goes back to the process and the total value proposition, because it's a good tool. And, I think there's obviously a lot of equity out there, and we've got the database to do it. So it all makes sense. You just have to make sure the process and the product you're selling and all that is good enough to where you feel good about it, and it's equitable for everybody.
Yeah. If everybody's on the same team, but it's about the house. In some ways the asset is the house, and then the mortgage is the liability on it. And you guys are educating families on better decisions. Michael, did you?
Yeah, Bobby, I was a little bit apprehensive to ask you this question throughout this time, but I do want to ask you, compared to, we've been talking a lot in the last few weeks about, obviously about UWM, brokers versus bankers. And so for you at Alcova, how do you compete with the broker community so you can change the narrative for you as a retail independent mortgage banker to say, whether you're bigger, better, or whatever, Alcova offers the best value proposition for you. And so how do you compete for that to recruits that you want to bring aboard? And even if and you might not even know they're recruits. They may be just interested in joining the team, but they're doing some research and they want to look to join Alcova. So how do you change the narrative to say, you know what, retail is not necessarily better, but broker isn't even better. It's a matter of we're the best company culture fit for you. You talked about this quite a bit, but how do you recruit so that you can speak to growing Alcova to last for 50 years? Because brokering only is very fleeting. It's like having a girlfriend. And so it's versus a marriage. And you've talked about that, I think. And so how do you compete to say, we're here not just to be better, we're here for you in the long run, for your recruits, for your team members. And I'd like for you to be able to answer this, to say, we're not bigger or better, we're just here for you.
Yeah. So it's a good question. First, I'll say that there's room for everybody. I mean, just much like a borrower situation, we may not be the best for a certain borrower situation. There might be a situation that someone has a financing need that are better off to go to a bank or credit union or whatever. So, they're same with a loan officer. There may be situations where, a broker makes sense. But I think as far as selling our value proposition, I'm certainly passionate about what those differences are. So I don't mind talking about them. I think, again, it goes to listening, because if you're listening to the recruit, even if they're not telling you they're necessarily leaving or whatever, they're just asking you about the company. It's like breaking down the value proposition, So if it's all about rate, lowest rate, it gets back to the conversation we were having earlier. Somebody out there has got the lowest rate. So, certainly you could broker and have 12 different rate sheets from 12 different wholesale lenders, and the lowest of the 12 or the two lowest of the 12 might be, really smoking. But the question is, can you get the deal through underwriting? How good is their process? And then the question becomes, what else do you need other than just rate and getting the deal done? Do you need marketing support, leadership support? That's where the relationship really comes in. All the other things in helping you build your business. And our company started out as a broker, so I think we can talk about this with some credibility. The first 5 years we were in business, we were 100% broker. The pitfalls to brokering and the difference is the control of the file. And I know that, brokers will say, well, you can send a loan into one underwriting. If you don't like it, you can pull it and send it to another group. That's easier said than done, because you've got different disclosures you have to get done with the borrower. And if you pull too many files from certain lenders, wholesale lenders, they'll have a problem with that. They'll have issues with that. And I think that's why you see, so many people send so much business to UWM. So if they're sending 95% of their business UWM, then they're almost like they're pretty close to a retail branch of UWM is really what they are. And I'm not saying there's anything wrong with that, but I think that's where it's like, let's be honest about that. That's really what they are. They're a lot of these folks are an extension of that. We were very similar with InterFirst. Back in the day, InterFirst was one of the best wholesale lenders around. We loved InterFirst, and we send them a ton of our business, and we had a great relationship. And until they got bought out by Citi, and literally almost overnight, their ops staff went from really great to mediocre to then eventually poor. And that's the lack of control you have when you broker, is you don't know when that's going to happen. You have no real true control over the service level from underwriting, closing, and funding. So our value proposition is we do control that. And so if you have a problem, you can come direct to the source and we can work it out and make a decision. And, there's no hope that an underwriter from a wholesaler might see it our way. We to a certain extent, obviously we don't force underwriters to sign off on things, but it's our process. So it's our team. It's one team. It's not 7 or 8 different teams you're banking on one team. And if we all work together and we have a strong relationship, we should have a strong value proposition, because we can do the same thing. We have over 15 correspondent lenders we work with. So we can technically speaking shop rates too, but amongst that group. But the difference is we have one way to get the loan done. We control the processing, underwriting, closing, and funding. So we don't have to worry about one of those wholesalers losing their ops manager and having subpar operational support for a few weeks. We don't have that risk.
I love that you're saying that, because if I were to break down, and I'm on the West Coast, so obviously you don't have a presence over here, and it doesn't look like you're going to anytime soon. But if I were to break Alcova down, if someone were to come to me and say, "What do you think about Alcova?" I'd break it down. Number one, that you foster an environment of communication, and that fostering of communication, which I appreciate in your explanation multiple times, is that it's okay to talk to the top. It's okay to talk sideways, meaning sideways in the organizational chart, not sideways in communication.
Yeah.
But also being able to communicate from top to bottom, meaning that a lot of clients and borrowers, owners, whatever, they don't necessarily understand that it's not just about the underwriting guidelines, but it's about communicating those underwriting guidelines so that the loan, not only the loan gets sold, but also it's like, this is what we need to do to make this fit in this box, because not everybody knows how to explain and communicate their situation so that it does fit. And I think that that's the part that I'm appreciating about how you are doing your business right now, that you're communicating it from the top to the middle to the bottom. And then as a result, from your branches and your originators directly to the street, to the buyer owner.
Let me jump in real quick too with a final question before we jump over to the mic drop. This final question brought to you by Adopt the Brand sponsors Velix Valuations and Silverworks Solutions. Michael, any you want to add with your family office?
Yes, with ARC Family Office, we are funding nationwide cross-collateralized reverse 1031 exchanges. If you don't know how a reverse 1031 exchange works, everybody knows the forward 1031, but go ahead, give me a like, follow, or question on LinkedIn if you want to know how it works and how we work with your tax advisor as well as your real estate professionals to do the reverse 1031 exchange.
So the final question, and we don't have a hard stop here, Bobby, so this is just the final question, and however long you want to answer it. The purpose of this show really has been for loan officers, processors, underwriters, people that have been unable to go to as many conferences as I have, or even one conference, and understand what a big mortgage world it is, but how small it can be. And especially once you find a niche, a track through education, let's say, you form a cohort, and it's almost limitless what you're able to do based on your talents and passion. So one cool emerging story, as we had Bill Dallas on explaining as a wholesale lender some of the brokers he had, Chris George, Victor Chiarelli, that's CMG, that's guaranteed rate. You just mentioned it. And then in light of Nex's recent article, you have partners that have been together 20 years. And I was talking with somebody, you're talking baptisms, birthdays, graduations, with that partner. And now it seems like it's all gone over this, but they did have a great 20-year run. As you talk about that story and the brokers out there that eventually want to become an IMB and then get to your size, 500 employees, and get to that next top 10, size that people like to talk about, what are your thoughts on doing it by yourself, or the benefits of doing it with a partner or with a team? Like, I know Rob's been great with you, and you guys complement each other well. And then maybe just talk about what some of those plateaus are that you have to get over to get to the next level each time, to go from a branch to multiple locations to where you are today, and then where the larger ones are tomorrow.
No, I can talk to that. First, on the partnership, I think it's very important to make sure you surround yourself with people that think differently than you do. So whether that's a equal partnership or a board of directors, or just a senior executive, whether you're going to share the ownership or not, I think that's very important, because you want a little bit of diversity of thought there to challenge each other. I mean, I've got 2 partners, and both of them are engineers, and I'm wired to, as a salesperson, to go and get the deal done, and they're wired to think a little bit differently. And that's worked well for us. And because even though they think differently, we share the same values. And I think if there's a value mismatch, or you're not aligned, or there's a trust issue, that's where you really have problems, especially down the road. So I think as long as you're aligned, have the same alignment and values, then you want somebody that thinks a little bit differently otherwise about how to go about tackling problems. So I think big believer in partnerships. As far as going from, broker to banker, I think you got to determine your risk profile and, what you want, because if you want to maximize earnings, you're not going to do that by growing your business from broker to banker for several years. And the reason I say that, having lived it, is, to get to the next level, unless you have a lot of outside funding, and that's an issue in of itself. And for instance, if you had an outside investor that gave you money, which we did not have, we used our own funds, then you've got someone calling the strings, telling you what to do. And again, back to the value issue. So assuming you don't have a lot of outside funding or heavy capital partners, you're going to have to reinvest to get through those hurdles. You're going to have to reinvest to show the warehouse bank that you're serious. You're going to keep cash in the company. You're going to have to grow your net worth. It's not enough just to have enough to run the company. You got to have certain net worth requirements. And the only way to do that is to earn your way to it. So your personal income is going to suffer from that. So if you're one of those folks that says, I really want to maximize my income over the next 5 to 7 years for whatever reason, whatever your life situation is, then going from broker to banker is probably not going to be the best. And I'm talking full banker. I'm not talking about like the stepping stone mortgage banker. I'm talking about the full delegated underwriting, all that. You've got to have the net worth requirements and so forth. So you have to take earnings from the company. You have to be committed to lead them in the company. That means paying taxes and doing all those things that aren't fun on a profit that you're not really realizing yet in terms of your personal gain. So you have to sacrifice a little bit. Now, if you're willing to do that, down the road, then there's some advantages to scale and certain things you can do. And then you can start to reap some of those benefits because you can do more than, say, a smaller company can do. For example, jumbo underwriting in-house, Fannie Freddie approval, sell direct to the agency, service your own loans. But those don't come without getting to that point, building your net worth, showing that you can handle that responsibility. And that takes time, not just the profit, but that takes time. How long you've been doing this, telling your story, that sort of thing. So an alternative to that would be to partner with someone like ourselves. We have a profit and loss model, and we look at our branches that run the profit and loss with us as a partner. Obviously, there's restrictions, Dodd-Frank compliant and all that kind of stuff, but they're a W-2 employee, but we treat it much like a partnership. And you can have a lot of the autonomy that you would run in your own company in many ways, and make local decisions on marketing and the support team you need around you and the investment you're going to make in the community and things like that. But you don't have to worry about the overhead, the buybacks, the warehouse lines, which by the way, all require personal signatures for a long time. So you're personally on the hook. You get a $20 million line, you've got $20 million outstanding, your personal name. So you have to be prepared for all that if you want to do that. Or you can partner with somebody like us. You may give up a little bit of the upside, but you don't have to make near the sacrifice, and you can have a team. So you can be in business for yourself, but not by yourself. So we think that's a very big value proposition that we offer, and that's not a bad way to go either if you want to take that next step up and have more of the in-house team feel, but not have all of that risk.
Very well said.
Yeah, very well said. Bobby, thank you so much for joining us today on our show for MoreTalk. I mean, we're getting the leaders of our industry, captains of industry for the independent mortgage bankers. It's awesome not only to hear the stories, but also being able to have a raw conversation, their businesses, what's been going right for them, and how they've been really able to navigate through the waters of this one. And for our listeners that are out there right now, like and subscribe on YouTube and Spotify. And we're here every Thursday at 11 a.m. Pacific and
2 p.m. Eastern.
Every Thursday, the longest running show where we have no affiliation with any mortgage company. We're going raw, we're going genuine, transparent, and we love to ask the questions to make sure that all originators, support staff, and other IMB leaders and broker community leaders are here wondering what their not just competition, but their colleagues as well are working with. So thanks for joining us today. Thank you very much, Bob Lee. We'll look forward to seeing you on the mic drop shortly. And until then, we'll see you next week.